I'm David Gibb, the Portfolio Manager of the Anchor BCI Worldwide Flexible Fund. If you're interested in investing offshore, this is the fund you might want to take a look at. It's a rand-based fund, and I will convert those rands to offshore currencies and invest in a range of shares or bonds, or leave it in dollars or pounds or euros. So it's definitely worth considering if you have too much of your money invested in South Africa. So what are some of the details on this fund? So firstly, it's on the BCI platform. So all the administrative contact will be with BCI. Our annual fee is 1% plus VAT. So it's 1.14% per annum. There are no performance fees with this fund. And there is full flexibility in the fund. So either we might, if we're really keen on equities, we might have 100% invested in equities. And if we're not that keen on equities, we think they're expensive, we might have less than 50% in equities. So I think that's probably enough on the details of the fund. And what is our investment philosophy? Well, the approach we take here is very long term. So there's very limited trade in this fund. We invest in companies with a durable competitive advantage, and we invest with them for the long term. So you'll notice that the trade in this fund is very low, and we invest in companies that are difficult to break. So you'll find that you might recognize a lot of the names in this fund. You might not recognize some of the mid-caps that we might own, but generally they're very good companies run by very talented management teams. Right, so I'd like to give you an update on the Anchor BCI Worldwide Flexible Fund and what we've been doing over the last month or so. So at the end of last year, at the end of 2015, we had a relatively conservative approach to global equities. We felt that the profit cycle has probably turned over. In fact, earnings in 2015 were down in the US, and we felt that certain sectors would probably be under pressure. Having seen profit margins rise over many years now, and probably not much scope for them to go much higher. But what's been handy for us really has been this market correction in January and February. So we've taken advantage of that, and we've increased our equity content marginally. We're up closer to the mid-60s now, from about 60%. At the end of last year, we had introduced 2 new holdings to the fund. The first one was an Oak Tree Capital, a distressed debt manager in the US, possibly the biggest distressed debt manager in the world. And the other one was an IBM, a big multinational IT company that had been through, it's been through some turmoil in recent years, largely because of the rise of cloud computing and the effect that that's had on hardware and a few other divisions. But we felt that IBM has several growth areas within the business, and some of those have really just been underappreciated by the market. So those 2 holdings were introduced at the end of last year, and if anything, we've increased the weighting of those 2 holdings, so that's Oak Tree Capital and IBM. And then we've also introduced 1 or 2 smaller holdings, which we can get to talk about possibly in our next update. So equity content is now approaching 63, 64%. So we've taken advantage of some advantage of this correction. We still feel that global equities are not necessarily that attractive, particularly in Western markets. So we're certainly not ready to up the equity content over 80%.